Hi everyone, Alex from Summerhill, just with another quick video update. Now the Labor government handed down the federal budget earlier this month, and today I wanted to cover off on the impact from a wealth perspective of the budget announcements. Now from a wealth perspective, the budget announcements were limited and had mostly been communicated prior to the formal budget speech. It was more about what was not announced in the budget that is of perhaps more importance to many. So from a personal taxation perspective, there were no announcements around extending the low and middle income tax offset. The impact of the low and middle income tax offset no longer apply and will be felt from 1 July this year when you start to submit your 2023 income tax returns. Those with an income below $126,000 will see their tax payable increase by up to $1,500 compared to last financial year. There was also no announcement regarding the personal income tax changes that have been legislated to take effect from 1 July 2024. This means that all taxpayers with more than $45,000 of taxable income will have a reduced tax liability from 1 July 2024. Moving on to superannuation. Now the cap for determining how much can be contributed to super as an after-tax contribution and how much could potentially be transferred into a superannuation income stream account upon retirement will increase on 1 July from 1.7 million to 1.9 million. The government has decided not to interfere with these legislated processes and increases. As a result, this does create opportunities to transfer additional amounts to pension phase from 1 July 2023. Also, for those in accumulation phase, there may be the ability to contribute further amounts to your superannuation. Now, we will obviously discuss these opportunities with you individually if they are to apply to you. The superannuation guarantee rate will continue to increase. The rate of superannuation guarantee will increase on 1 July 2023 from 10.5% to 11%. And finally, if you are receiving an income stream pension, you may remember that the minimum pension payment required had been halved in the past few financial years, resulting in a lower amount that needs to be withdrawn from your super. At this point, the government has not announced any further extension to these reduced pension payment rates. If no additional changes are announced, the minimum pension required will return to the standard rate from 1 July. This effectively means that the applicable rate from 1 July 2023 will double. If you are currently withdrawing more than the minimum pension, this reversion back to standard minimums may not affect you. However, if you are drawing the minimum pension amount, you will be required to draw a higher amount from 1 July. Once again, we will discuss this with you individually in terms of how the change may impact your cash flow, and we'll assess and provide recommendations for managing that additional cash flow. The notable proposed changes to superannuation from the budget are the government has announced that employers will be required to pay their employees superannuation guarantee entitlements at the same time as their salary and wages. Currently, employers are required to pay their employees' superannuation guarantee contributions on a quarterly basis. So this change means you'll have amounts paid into your super fund earlier, allowing for more time for growth. However, the change will not be due to take effect from 1 July 2026. And consistent with the pre-budget announcement, the government has announced that they intend to reduce the superannuation tax concessions for those with more than $3 million accumulated in the superannuation system. So today we'll discuss that proposed change in a little bit more detail. So, what is the proposed change regarding the $3 million super cap? There will not be a limit imposed on the size of superannuation account balances in accumulation phase. However, individuals with a total superannuation balance greater than $3 million at the end of the financial year, which will be first tested 30 June 2026, will be subject to additional tax. Generally, your total super balance is the sum of all amounts that you have in the superannuation system. So that includes amounts in a pension account or defined benefit and in an accumulation account. Earnings on amounts in accumulation phase above $3 million will be taxed at 30% rather than the existing 15% tax rate. The additional tax will only be payable on earnings attributed to balance that exceeds $3 million. If your total super balance is less than $3 million, the change will not impact you. The investment earnings on your accumulation phase balance will continue to be taxed at a maximum rate of 15%. The $3 million threshold applies to individuals, so couples could still have up to $6 million in super and pay the current 15% tax on earnings in their accumulation accounts. Earnings for the purpose of the assessment will not be actual fund earnings, but will instead be based on the individual's total super balance at the start and the end of the financial year, after adjusting for any contributions and withdrawals made during the period. If the individual has negative earnings for a year, they may be able to carry this forward to offset any additional tax which they become liable for in future years. Existing capital gains tax concessions and franking credits on share dividends available to the super fund will not be impacted and will continue to be able to reduce the effective tax rate on savings held in super. The additional tax will be able to be paid by the individual, or it can be released from the superannuation fund. The changes will also apply to defined benefit funds. Based on statements made by the government officials so far, it does not appear that the $3 million cap will be indexed. And it is also important to note that if a condition of release is not met, i.e. if you cannot access your super, it would not be possible to remove amounts in excess of the $3 million super cap. When will the change start? At the moment, it is a proposal only. But based on information released by the government, it's currently intended that the change will commence on 1 July 2025 and that the notices of additional tax liability will first start being sent out in the 2026-27 financial year. Now, there are several industry concerns, namely the lack of indexation in the $3 million cap is deemed inappropriate and will be a major point of contention. Taxation of unrealised gains, the timing of asset revaluations, listed and unlisted assets, issues with the ability to pay the additional tax, particularly if you're holding illiquid investments, and how it will work for defined benefit pensions. It will therefore be necessary to wait for the legislation to be introduced before a range of these issues will be clarified. So, should you be making any changes now to your retirement savings strategy? If legislated, this measure could have tax, estate planning and retirement planning implications for those with higher superannuation balances. At this time, it is best just to be aware of the possible change, await the final legislation and detail before considering the best option for your circumstances. It's important to understand that the most appropriate option can be different for everyone and can even change as your personal circumstances change. Given the government are suggesting that it will apply from 1 July 2025, we will have some time to wait for that detail to be released and to assess appropriate strategies moving forward. We will be monitoring the proposals closely and will discuss them with you individually if it does impact your financial strategy. So that's it from us for today. As always, it's important to remember that at this point, most budget announcements are only statements of intended change and are not yet law. The specifics of each of the changes will be discussed with you individually at your next planning meeting. As always, please contact us if you have any further queries. Thanks.